So welcome everyone to this, I think this 10th webinar we're organizing as Altfinator internal webinar. This time I will discuss one of our deliverables, the investor manual, where we will go into the different types of potential investors in alternative finance. Because there is a lot of course, we are focusing on the SMEs, looking for funding, access to finance, but it's also important to look into the sources of capital. How can we attract funding for these SMEs and for these different types of alternative finance? So what I will do, let's see if I can switch. Yes, I have three different perspectives that I want to raise here and I want to discuss. The public, so what can the government do? The private perspective, so what can individuals do, business angels do to invest in alternative finance, and what are the important things they should look at, and what is the institutional perspective? And I mean with institutional perspective, institutional investors, so pension funds, but also the European Investment Bank, European Investment Fund, providing a lot of funds, have a lot of funds available also to invest in the real economy, and they can use alternative finance to do that, or at least to boost investments in alternative finance. They can do that directly, they can do it indirectly. These are the main topics that I want to discuss today. For the people who joined a bit later, I don't expect we need the full hour. If you have any questions, please leave them at the chat. During my presentation, I will try to answer them as soon as possible. And of course, afterwards, we all, of course, have time to open the floor for any additional questions, perhaps for topics I didn't discuss, or if there are still any questions after my presentation. So we have the manual on our website. So for the participants that are not part of the Altfinator project or that are listening to this webinar afterwards, if you go to the Altfinator website, we have a download section with our deliverables, and one of them is the Altfinator's Investor Manual, where a lot of the information that I will also discuss in this presentation, this webinar, will also be written down in a document. So if you prefer to read it, that's also a way of getting that information. So to start with the private investors, perhaps this is the most common model for alternative finance, especially if we talk about crowdfunding, we talk about business lending. There are a lot of individuals that are supporting individual projects, individual companies already at this time. I will not go into all the specific alternative finance models. We've discussed these in previous webinars. We also have the MOOCs, where we get a very detailed explanation about the different types of funding that is available for companies. But I will dive into a few of the main categories to show how it works that private investors can participate in alternative finance. Because this is money from individuals, from citizens, sometimes it's their saving or it's the pension money. I will first start also with some general tips to explain what the risks are for these individual investors and what for them is a good strategy. Afterwards, I'll go into a bit more detailed the three of the different models, the peer-to-peer business lending model, equity crowdfunding, but we'll also touch business angel investments, because there's of course also a possibility for private investors to participate in companies. And one very important tip, I will look into tax incentives. In several countries, there are interesting tax incentives available for you as an individual investor to support these companies. So start with these general tips. First one sounds logical, but it's not always the case. So invest only in what you understand. It's the same motto that everyone who's investing in other companies is always getting. Don't just follow the crowd. Don't just invest because a friend of a friend advises you to invest in a certain company. Try to understand what kind of company it is, what kind of industry it is that you're going to invest in. This way, you can reduce your own risk. If you don't have any experience in a specific industry, make sure either you're getting information about it, try to learn, or try to get into contact with some experts, or perhaps don't do it and just find some other business opportunities or investment opportunities that are more suitable for you. Or, and that's the second thing, make sure that you spread wisely. So make sure that you are not just put all your eggs in one basket. You can reduce that risk by investing in several types of companies. What's also important, just a general investment advice. If you're investing, don't use all your savings. Do it with your savings that you can, that is additional money you can spare. Sure, you can get higher returns if you invest all your savings into equity crowdfunding, or for example, but it is also much more risky. And if it's your pension, it's too risky to invest all your money in that. So be wise what amount of money you invest. A lot of regulators, for example, in Europe, they use a 10% rule. So 10% of your savings you should maximum invest in crowdfunding. And of course, it's debatable. Why 10%? Why not 50% or 5% even? But the 10%, that's a very safe limit because especially specific types of crowdfunding are quite risky. So there can be a lot of defaults, a lot of companies go bust. And if you then lose all your money, you just lose 10% of your savings. So that's just a common rule to keep in mind. Of course, it's not an obligation. If you want to take a risk, sure, you can invest much more, but be wise how much money you invest in more risky types of businesses. I mentioned already shortly before, if you're investing in projects in companies itself, but also therefore also if you're investing through alternative finance platforms, spread your risks. And it means on different levels you can diversify your investment. One of them is time. If you're buying stocks, also in the stock market, but also through alternative finance, don't invest immediately all your money at the same time. Take your time, for example, 12 months, 24 months, to slowly build up your portfolio. This way you will reduce the risk that with a specific crash, financial crash, for example, you have a lot of money invested just on the peak of the hype cycle. Another way of diversifying is spreading over different industries. So not only investment in internet web shops, for example, or in shipping. So try to diversify also through different industries. Therefore, if one of these industries is getting into trouble, not your complete portfolio is getting a negative return. And the last way of diversifying is invest in different types of risk. We'll come to that later, the different types of risk, but you have low risk investments with a fixed, perhaps low interest rate, and you have a higher risk investment in equity, for example, and everything in between. Try to balance your portfolio also, that there are different types of projects in your portfolio. Another way of making sure that you reduce your own risks is using a professional platform. And especially now with the growth of alternative finance, we've seen a lot of platforms popping up everywhere in all countries. not all of them have a very high professional standards. So how can you see if it's a professional platform? So one way of seeing that is see if they are a member of an industry association, for example. Most of the time, these industry associations have strong self-regulation rules, code of conduct, and that ensure that there is a protection for the investor. It goes further than the regulator will ask. Most of the time, there is more transparency also in the defaults of the platform of the different projects. So it makes it easier for you to calculate also your net returns and the amount of risk you're taking with this investment. So the last point I managed to already understand these risk return ratios. Savings on a bank account are very safe. You're protected by law. If there is, if even in the small, if there's a small risk of a bank getting bankrupt, you still get your money back from the government. You have a nice scheme for that. But also you get 0% interest. On the other hand, there are these small startups promising very high returns, fast-growing unicorns you can invest in. Very high risk. The chance of getting anything of your money back is perhaps just a few percent. So 95% of the cases, these companies will fail. And there are a lot of different risky investment in between. Some companies that have been growing already for a couple of years, that want to innovate or that want to expand to a country. It's a bit more risky than putting your money on a bank account, but therefore also you get a few percent interest rate. Or you get an equity share, but you know for sure that that company is not going to be bankrupt in 6 or 9 months' time. So therefore, also to get back to diversifying your portfolio, make sure that you understand the risk. Invest partly in low risk projects and a part of your funding in higher risk projects. Of course, higher risk projects can also create higher return. So if you have an investment portfolio with 10 startups, perhaps you are lucky and one of them will be successful, and then you still make a positive return, even if these other 9 of these companies will not make any return. So that's important for you as an individual investor to understand. So, and if we look into the risks and the potential of the different types of investing. So if we start with peer-to-peer business lending. What's important to understand here is you're lending money directly to a company. In return, you will get a fixed interest rate. Most of the time, the loan is also fixed. The time it's 4 years, 5 years, 3 years sometimes. What is important for you to know that the interest rate the company is paying is not your net return that you will get in the end. So, for example, if the company is paying 8% interest, you have to take into account that you as an investor also have to make costs. So most of the time you have to pay some costs to the platform. Say 1% of the costs have to be paid to the platform. So in the end you only have 7%. But on top of that, you have to take into account that a few of the companies will not be able to repay the full loan. So it's a loan, but if the company in 3, 4, 5 years get bankrupt, you lose the rest of the money. So you lose not all of your money, because most of the time the company starts repaying in the first month after the loan, but you lose part of your money. Most of the companies will not have a problem, so perhaps 8 or 9 of the 10 of the companies will just repay all the complete loan, but you have to take into account that there is a small percentage that will not repay. So the industry calls it defaults. That's also how banks communicate. It's also how banks work. They also know that some of their clients will not repay their loan, so they always have a certain amount or a certain percentage of defaults in their portfolio. So you as an investor also have to take that into account. So from these 8%, you already have to pay 1% to the platform, and perhaps you also have to take into account that 2% in the end will not be available for you because of these defaults. So that's also something that you have to reduce from your net return. So you only have 5% left. 5% is still fine. But it can happen when there is an economic downturn, for example, when there is an economic crisis. Perhaps not just 1 out of these 10 companies goes bankrupt, but 3 out of 10. And instead of having taking into account 2% extra cut on your interest rate, perhaps you have to take 6% or 7%, and then you perhaps have a negative return. So be aware of that this is possible. If you're using peer-to-peer business lending, you're providing these loans to big companies, take into account that the interest rate is being paid by the company directly. It's not your net return in the end. You have to take into account these costs and the defaults. I've put one element there, the guarantee scheme. So in some countries, the government or sometimes even the platforms provide insurances, guarantee schemes. So when there is a problem, when there is a default, for example, it is possible to get some of the funding, the investment back. Of course, this is nice, but the downside of it, of course, someone needs to pay for it. So it works more like an insurance. Most of the time, the platforms will have to pay a certain amount for every project that they put under this guarantee scheme, and that will just flow into one big fund, and that fund will repay if there is a default. So then your net return in the upfront will already be lower, or the cost for the entrepreneur will be higher. So it depends on how it's being, who's going to pay it, and how is it being structured by the platform. So these are several main topics you have to look into as an investor into peer-to-peer business lending. If you look into equity type of models, so starting first with equity crowdfunding. I already mentioned high risk, but high return possible. There have been some very interesting equity crowdfunding campaigns in the last couple of years, where investors got more than 1,000% return on the investments because the company, after a few funding rounds, became a unicorn. And the initial funding rounds were done by crowdfunding. But now, what I said already, 9 out of 10 of these companies will not grow that fast, or will never get an exit, because that's also an important risk in investing in equity. It's an open-end investment. So when you're buying any shares, and especially within equity crowdfunding nowadays, you never know when you can sell these shares, because there's no secondary market available. So it's not like an exchange where if you need the funding, you go to the stock exchange and you sell your shares in a big corporate. So you have to wait until there is an exit. Now, an exit can be that the company is being sold to a larger company or to a competitor, and that's more a UK or US model, when that company is taking an IPO. So initial public offering, and is being listed on a formal exchange. That's a very special one, because then indeed you can sell your shares, but it takes normally a long time, around 10 years before that company is listed on the stock exchange, and most of the companies never will reach that stage. But then still, if you want to sell your shares, you have to find out, are there any other shareholders that want to buy your share? Can you sell them back to the company? Sometimes the company buys these shares from initial and early investors. But otherwise, you just have to wait, and you're stuck with your shares. So that's something that you have to keep in mind if you're investing in equity. It's not a very liquid model. You are stuck in the company. But if you have the time, it can be a very lucrative investment. Specifically with equity crowdfunding, to understand is that most of the time you will invest not directly in the company, but in an SPV, a special purpose vehicle. That means that it's a special legal entity that's being created after the investment round, and all these crowdfunding investors will be investing in directly in that SPV, and that SPV will hold the shares of the total investment. That also means that you don't have any direct say in the company. So most of the time, it's you have the economic rights, but you don't have the voting rights in the company. So that's important for you to understand. So if you, as an investor, want to invest directly in a company and also want to have a say in the activities of the company itself, you want to have you want to sit at the table with shareholder meetings, and then it's better for you to choose business angel investment model. So as a business angel, it works the same as equity crowdfunding, but for higher amounts. So instead of 100 people investing €1,000 each, you will have one business angel investing €100,000 directly in the company. But hereby, most of the time, you will have direct voting rights. So you can sit at the table, discuss with the founders, discuss with the other shareholders the direction of the company. For some people, especially if you have more funding available, it's a more interesting way to participate in these companies. So what's important for both, so the business angels and the individual investors, is to understand that there are in several countries in Europe, there are specific tax incentives to help you to invest and to support the investment in SMEs. This can be so when it can be models where you can put your money in a fund where it's not taxed at all, so you can use your savings to invest in specific companies. Well, another model is that if you invest in equity crowdfunding and anything goes wrong with the company, that you get part of the money back. But this is very specifically focused on national tax regimes. This is not harmonized in Europe. It will never be harmonized in Europe because tax regimes are very difficult to harmonize. So it's always important for you to reach out to a local tax advisor who can guide you and help you with it. Most of the times, the alternative finance platforms themselves, because it is very useful for them, can also provide you the basic information about it. So they cannot advise you on it because they are not tax advisors, but they can point you into the right direction. They can explain you how these models work, like the size model in the UK, and send you additional information. So we've now discussed the first element. These were the private investors, but what can the government do in alternative finance? In fact, they can do. There are four types of models they can use. Of course, they can invest directly. That's something I will discuss with business lending, peer-to-peer business lending, or marketplace business lending. Guarantee schemes they can use. Again, I will discuss quickly the tax incentives, but also co-investment, so match funding. That's an interesting model, especially for local governments, so not for national local government, but especially for local governments, to support civic crowdfunding initiatives. I will checking. I see a question from Francisco. As you say, some crowdfunding platforms are experimenting with a secondary market managed by the platform. This is forbidden by the current Spanish legislation. Do you know whether experimenting with secondary market managed by platforms, is it allowed in the EU crowdfunding regulation proposal? Francisco, very interesting question. Indeed, like in Spain, in most European countries, it is not allowed for a platform to run a secondary market at this moment. But there is good news, in fact, that within a new crowdfunding proposal, the European crowdfunding proposal, there will be a limited market possible. It's not a full market, but it is a bulletin board. So that means that if you want to sell your shares, you can put it on a bulletin board, and people who are interested can buy it. So it's more kind of marketplace. So you will not set the value as a platform, as a crowdfunding platform. That's not something you're not allowed to do that. And it's not an active trading platform. For that, you need to have, you still need to have a much heavier regime. But it is possible. We have in Europe also MTF licenses, multi-traded facility licenses, and that allows you to start an exchange. But that's quite a heavy license. It's very the requirements for acquiring that is quite difficult. For example, you need to have €1 million in capital always available in the company. So therefore, there are not so many of them in Europe. So I expect a lot from that. So especially for crowdfunding, where you don't need to have immediate sales, you don't need to have high volumes of trading. Such a bulletin board will be quite useful for selling some shares or bonds, because that's the other thing. So a loan is kind of under the counter and direct lending, but if you create a bond is tradable. That makes it also easier. So back to the government. So we have these different models. So if you start with business lending, there are different models. So you can use, you can provide capital directly. So example, the British Business Bank was a good example. A couple of years ago, they funded directly through several alternative finance platforms loans of SMEs. And especially in the beginning, it was 5, 6 years ago, it was in the beginning of the crowd lending industry, particularly business lending industry. And it really helps to build up trust for the platforms. Because the British Business Bank was providing first tens, later hundreds of million pounds and lending out through these platforms, it gives a lot of credibility to the platform itself. They could also reach out to individual investors and say that the British Business Bank was also investing through the platform. They were funding 10-20% of the funding, most of the time, for every loan. And of course, there are a lot of advantages as a government to do this. So there is the direct support of the economy. So you are providing that funds directly to individual companies. It's not going through a fund or a bank or a very indirect other investments. So I mentioned already, that's the trust that it creates for the platforms, but it also has a very strong multiplier effect, because if you just have to invest that 10%. So for every 10 million you are investing through these platforms, there will be 100 million available for SMEs. So for government, always a very important issue. So they can multiply the investment in the real economy by providing just, for example, 10% here of the investment. On the other side, if they don't want to provide funding directly to the industry and to the platforms, they can also come up with these guarantee schemes. And these can be different types of guarantee schemes. In general, it works that it will guarantee investors for losses on investments. Main advantage is that it's very low cost, because if nobody is using it, they don't have to repay anything. Again, it will boost the trustworthiness of the industry itself and provide additional trust for the industry, because you can invest in certain companies and you know that if anything goes wrong, there is always the government backing it, or there is a government scheme backing it and providing you the money to reclaim your funds, reclaim your investments. What is also helping is that because there is that guarantee scheme, the risk for the platform or the risk for the investor is also lower. So therefore, the interest rate for the companies can also be lower, or higher interest for the investors. So these are advantages, and these are activities the government can do directly with the investments. And these tax incentives, it really works well. You see that in Belgium, they started with these investments, the tax incentives already. They do it for a long time already for the media industry. A lot of films are using Belgian companies to finance their production. They get a lot of tax incentives there. We see in the UK that the crowdfunding market is growing really fast with these tax incentives and the peer-to-peer business lending, especially because you can put a part of your savings every year aside. It's not taxed at all, and you can use it for your future income. So, for example, for your pension, but only if you're invested in certain type of projects, in certain types of companies. And in this case, if you're using some of these alternative finance platforms, it is also exempted for tax, so you can invest. And also the capital gains most of the time are also exempted, so you don't have to pay the capital gain tax on top of that. So these things work really well. But it really depends in what way it's being implemented in countries. In the Netherlands, for example, we don't have these tax incentives, and one of the reasons is that the company claims that they will lose a lot of tax money for this, and of course that's true. But on the other hand, they also lose a lot of potential for individuals who can be supported to invest much more funding into small companies, risky companies, but also innovative companies, and so invest in the future of and future income also of the government. So last example, so how can the government participate in this, and is by co-investing. So while with peer-to-peer business lending, they're just providing standard sum money and distributed to these platforms. With match funding, especially with local government, it's a way of perhaps even replacing part of the grant system for local projects. For example, there are a lot of civic crowdfunding initiatives where citizens themselves can start up their own project. They try to raise funding for it, and if 50% of it is reached, then the second 50% will be provided by the government, or the government will always provide 1/3 of the funding in the beginning, and then the citizens themselves have to finance the rest of the 2/3. And why replacing the grant system? Because there are a lot of requests, of course, from local projects from citizens that want to get some funding from the government for all kinds of local initiatives. You need a lot of government officials also to research and to advise if it's an interesting and a useful project, and also if it gets enough support from the local citizens. But if you just turn it around, you just ask the citizens themselves, just come up with your proposal, try to raise some of the funding so you can show that there is additional support and there's enough support from other citizens. Then it makes it easier also to finance the rest of the project. So this is a way how directly the local governments can finance it. So we've had the private investors and the government, and I just, in the end, quickly, I want to look into the institutional investors. And if you talk about institutional investors, these are quite diverse. So these can be pension funds, billions of euros available, but also family offices investing in the name of specific wealthy families or groups of families most of the time. Insurance companies with a lot of capital available, but also banks, because banks are also looking for investment opportunities and financial returns, and especially for small businesses. For them, it's really difficult to invest in that industry. It is too high cost for them to maintain all these small loans. So perhaps they want to participate with in small fintechs and provide the funding for them. And on a European level, the European Investment Bank and the European Investment Fund are very active nowadays in providing funding available, and also guarantee schemes, by the way, but providing funding for alternative finance platforms, so to finance their capital. So how does it work? So what is the advantage for pension funds, for example, to work together with a marketplace, a peer-to-peer marketplace? One of the advantages is that they can automatically spread their investment. So most of the time, for 100 million or 500 million, these are the ticket sizes that they want to invest in. That's something that they can put a risk manager and a portfolio investment manager on top of the investment. So they will not invest these small 1 million euro loans. But if they invest that money through a platform, just like the British Business Bank did in the past, it will automatically be invested in a lot of the small loans, and they will not take the full loan, they will just take a part of that loan, and that will balance their risk automatically. Like I said, for individuals, it's very important to spread your risk in different types of loans. This is something that they can do automatically because the platforms will support this. And their main advantage is they can still invest directly in small businesses, directly in the real economy, but they don't have to manage all these small loans themselves because that's outsourced to the platforms. They will do that for them. But this way, their money will be directly connected to these individual loans. Yes, it is spread, but the returns are not clear, because if there is an economic downturn or the expectations were lower than expected, then or the outcome is lower than expected, then you will never know what your return is. So one other model is a balance sheet lending model, where you still have that 100 million, you lend it to an online platform, but it's on their balance sheet. So they will take the risk of making a return. And as an investor, you will just get a fixed interest rate, for example, 3 or 4%, and the balance sheet lender itself needs to make up the rest of the money. So up to 3%, 4%, all the returns go to the institutional investor. If they make any more profits, that money will be used for the balance sheet lender themselves. Has an advantage that you know that you have a fixed and stable return, but of course you need to trust the platform and the model of the platform that they will really generate a profit for you. These are the main topics I'd like to discuss at this time. Any additional questions or topics I didn't raise? I see already it's a 1:45, so it's later than I already expected. Don't see a chat, at least some topics. Okay, I don't see Oh, thank you, Dimitri. Yes, I don't see any additional questions. Oh, yes, one insurance question still from Dimitri. I will wait for that, and let's see if I can answer that.
Yeah, maybe I can speak rather than type.
Mm-hmm.
So my question, well, you talked about the guarantee options earlier on, and I was wondering whether the insurance companies are picking up or taking on some insurance aspects on this, like I don't know, pay slip insurance or insurance on mortgages repayments and stuff like that. Is there anything going on in the insurance market to come in from the private side rather than the more public or institutional side? Thank you.
Yes. Yeah, it's interesting to see that slowly now the insurance market indeed is looking into these opportunities. Not that much yet. A couple of years ago, I supported the AIG, UK, a large insurer, to create a model for an insurance product for equity crowdfunding for fraud protection. The idea was that if you raise money through equity crowdfunding and a company raising the money will take the money and do something completely else with it, so it's not investing it in the company, they will cover that with their risk, with their insurance product. Very specific, very niche product. It is implemented in several equity crowdfunding platforms, but I never really saw it taking off. I think also because equity crowdfunding in most cases is raising a lot of funding by customers, their own customers or their own family and friends. So the chances of fraud are quite low. Recently, I was approached by another insurance company was looking into the lending industry for a new model, and they're looking mostly in kind of micro insurance. That's something that comes up now. So, for example, in the sharing economy, you see that for ride sharing models, the insurance company is getting really innovative, creating an insurance, for example, a car insurance for a day, when you're just renting a car through these sharing platforms, these car sharing platforms. And these kind of companies also are looking now, can we also implement that for lending, crowd lending products? But they still are not exactly sure how to structure it. So to answer your question, yes, the insurance industry is slowly looking to it, but no, there are not a lot of them having fixed products available already that can be used. So I expect next couple of years that a few of them will have interesting models that can be used by the platforms, and that also will be very valuable for specific platforms. But it's always, for insurance, it has always a cost. So you always have to take into account as a platform or as an investor, do you want to pay that premium? How much is that? And is it worth it? And perhaps also it just needs to go wrong first before everyone understands that perhaps an insurance is a good idea. So thank you. Okay, so I think that we close this session with this. Thank you all for your attendance. I will also stop the recording so that people afterwards can listen to it. Thank you all for joining this webinar. I hope it was interesting. Looking forward to see most of you next time.